CoreWeave and Nvidia have struck a $6.3 billion agreement in which Nvidia will purchase any of CoreWeave's unused cloud computing capacity through April 13, 2032. This means that if CoreWeave builds out more infrastructure than its customers immediately use, Nvidia will step in to buy that excess capacity, helping CoreWeave avoid waste from idle resources. The news triggered a positive response from the market. CoreWeave's shares rose by 4.6% on the day the deal was disclosed. Investors seem to view this deal as addressing a major concern, that CoreWeave might suffer losses if its infrastructure isn't fully utilized. This helps allay some of those fears. Risk mitigation. One of the biggest business risks for cloud infrastructure companies is investing heavily in data centers, GPUs, power, etc., but then having parts of that capacity go unused. This agreement gives CoreWeave a guaranteed buyer for unsold capacity, reducing downside risk. CapEx burden. CoreWeave is in the midst of a huge capital investment plan. It expects to spend between $20 to $23 billion in data center infrastructure in 2025. Having a cushion like this can make that spending more palatable to investors. Strengthens the Nvidia partnership. Nvidia already supplies GPUs to CoreWeave and owns about 6.6% of its equity, which ties the fortunes of the two companies closely together. This contract further cements that relationship. Even with the deal, there are still important issues CoreWeave must manage. High upfront investment. Building and equipping data centers, especially for AI, is extremely expensive, and debt or cash burn may become significant if demand slows or if operating costs rise. Dependency on demand. Despite guarantee from Nvidia for excess capacity, actual demand from third parties will still be essential for long-term growth. If demand lags, CoreWeave could rely heavily on Nvidia to cover unsold capacity, which might affect profitability. Competition and technological risk. The AI cloud infrastructure market is highly competitive. Advances in efficiency, hardware, or regulation could shift the landscape. CoreWeave will need to stay ahead. Regulatory risks for Nvidia. There are also broader considerations, such as antitrust or regulatory pressure on Nvidia, which could in turn affect agreements with partners. Here are signs to monitor that will indicate how well this deal, and CoreWeave's strategy, are playing out. How much of CoreWeave's capacity ends up being unused and covered by Nvidia under this deal? If it's small, that's good. If it's large, it could show weak third-party demand. The pace of revenue growth versus margin pressure. Because operating expenses, especially power, maintenance, cooling, etc., tend to scale quickly in AI infrastructure, margins could be squeezed. Investor confidence. Whether the market responds positively to future quarterly reports, especially around CapEx, utilization, and debt levels. Competitive moves. What other cloud or neo-cloud providers do, and how pricing and hardware availability evolve. Regulatory developments, both in terms of hardware supply chains and any antitrust or trade concerns affecting Nvidia or its partners.